Picture this. You're 45, it's a normal Tuesday, and you've just written a check to clear your mortgage. All your savings, every last emergency fund dollar, even a small inheritance, gone. The house is yours, finally. You feel unstoppable. Relief floods in. You think you've done the smartest thing financially you could ever do. Now imagine 6 months later, your job disappears, your income stops, your bank account empty. That money you poured into the house, locked in walls you can't spend. Suddenly, your freedom feels fragile. You're rich on paper, poor in reality. Welcome to the liquidity trap, and this is where most people get it wrong. I'm Cade, and I spend way too much time dissecting the financial myths that keep people from growing real wealth. If you've ever been tempted to throw extra cash at your mortgage just to feel safe, this video is for you. Hit subscribe and drop a like because today we're challenging one of the most trusted pieces of advice in personal finance, why paying off your mortgage early isn't always smart. We'll dive into why locking cash in home equity can be dangerous, how keeping debt can actually make you safer, the hidden opportunities you give up by rushing to zero. Most people want to pay off their house because it feels right, not because the math says so. Fear of debt passed down from previous generations drives these choices. Back when mortgage rates were double digits, paying off debt was an obvious win. Today, with low rates, aggressively paying off your mortgage is like earning pennies in a savings account while missing out on much bigger opportunities elsewhere. Think about it. Would you lock $50,000 away at 3% when the stock market has historically returned 8 to 10%? Probably not. But paying off debt early does exactly that. It trades potential growth for comfort.
Here's a little secret. The banks know how to make money, and you can too. They borrow at near zero interest and lend at higher rates. That spread is profit. You can reverse the process. With a low-rate mortgage, your money can work in investments with higher returns. $100,000 extra cash. Pay down a 4% mortgage equals $4,000 interest saved. Invest instead at 8% equals $8,000 earned. That difference grows year after year. Over decades, it can turn into hundreds of thousands in extra wealth. Cash is king. Risk isn't about owing money, it's about access to it. Every extra payment to the mortgage reduces your liquidity. That home equity? It doesn't help when you need groceries, bills, or an unexpected repair. Scenario 1. Paid-off house, no cash. Safe in theory, but zero flexibility. Scenario 2. Mortgage plus investments. Shelter and the freedom to react to life's surprises. Which feels safer? The choice is obvious. Inflation is your friend. A fixed-rate mortgage locks in your monthly payments while inflation slowly reduces their real cost over time. What feels like $2,000 today might feel like $800 in 20 years. Paying off your mortgage early sacrifices this natural advantage, effectively giving the bank more value than necessary. Opportunity cost of extra payments. Every dollar thrown at the mortgage is a dollar not growing elsewhere. For instance, an extra $1,000 a month could compound into millions over time if invested wisely. Meanwhile, your house appreciates steadily, but the gap between the two can easily reach 7 figures. Psychology and lifestyle choices. A paid-off home feels liberating, but people often spend the freed-up cash on lifestyle upgrades instead of investments. Keeping the mortgage enforces budgeting discipline while allowing your money to grow outside the house.
Asset protection and taxes. Debt can protect you too. Smaller equity in your home makes you less attractive to creditors. And even though mortgage interest deductions are less common now, the math still favors keeping liquidity and investing for long-term growth. Here's the takeaway. Instead of sending extra payments to your mortgage, redirect that money into investments. Set up a freedom fund in a brokerage account, automate contributions, and watch it grow over time. Not only does this build wealth, it keeps your options open for emergencies, opportunities, or lifestyle flexibility. A paid-off house is comforting. A growing investment portfolio? That's power. If this challenges how you think about debt, share it with someone who's obsessed with paying off their mortgage early. Help them see why liquidity and smart leverage can be far more valuable than zero debt. If this video made you question the idea of rushing to pay off your mortgage, that's a good thing. Wealth isn't built by following comfort. It's built by understanding leverage, liquidity, and long-term thinking. Don't just aim to feel safe today. Aim to stay flexible tomorrow. If this helped you see money differently, hit like, subscribe for more nonsense wealth breakdowns, and I'll see you in the next video.